Hi friends, in this video we will talk about two very good mutual funds that you can consider for investing till the period of 2028, which is in a horizon of next 5 years. So if you are someone who is looking to build a portfolio of mutual funds with you and want to make some very good profits from mutual fund investing, then this video is for you. Before that, if you want to receive more such investing ideas and insights and recommendations, then you can consider subscribing this channel. Let's start with this video. As we start, we will go through all of these different points throughout this video, and the best part of this video will be this video is going to be very practical and a logical discussion behind selecting these mutual funds. So I request that you give your next 12 to 15 minutes if you are serious about mutual fund investing, because this 15 minutes is going to help you a lot into your investing journey for next 5 years, which will in turn help you to gain some bigger profit by investing in mutual fund. On the first point, let us understand what are the details we have as a retail investor behind any mutual fund. Now, why are we looking at the details first? Because we have to understand what drives that mutual fund, what kind of growth it would have, what would be the reason behind it. So let us go into the details first. So as you can see over here, this is not a mutual fund which I am recommending. No, it's not Parak Parik. But what we have as a mutual fund to know is this is a growth mutual fund. That means everything, any profit that this mutual fund generates, it will be reinvested in that mutual fund. Then we have a price chart over here. We have a highest and a lowest price of this NAV of this particular mutual fund. We have a compounded annual growth rate. This is one important point which tells us in the historical period what growth this mutual fund has had. Let us move ahead and see more details. So as a further information, we have an expense ratio which tells us what are the expenses that the mutual fund manager will charge us. Then we know the PE ratio of all the stocks this mutual fund company, this asset management company has invested. What is the average PE ratio of all of those stocks? We have a Sharpe ratio over here, which is a risk adjusted return ratio. So in a very simple definition, to give you a short example of what it is like a return by risk ratio. Understand that if you are investing in any mutual fund, there would be some upside and a downside to this mutual fund. So let's say this mutual fund is expected to go down by maximum 50%, 15%. So your return in against that, if it is at an average of 15%, that means your Sharpe ratio is 1. Now what we want is we want higher return. The returns to be 30, 50 or higher than that. So it is better to have a Sharpe ratio more than 1, 2 or even 3 to that matter. That means compared to the risk that we take by investing in this mutual fund, our returns are better. Then we have a category expense ratio, which is basically all the mutual funds in this category. What is an average expense ratio of that? Likewise, category PE ratio and category Sharpe ratio. These are all different data points we have against investing in a mutual fund. Let us move ahead and see what all information we have. So here it also tells us about the plan, the lock-in period it is there, what kind of exit load you have. So if you exit in this mutual fund, your portfolio will be charged for 2%. Then the next point we have is peers. What are the competitors which are in the same mutual fund category? If it is a flexi cap, all different flexi caps which are competing with each other, these are all those peers. Then here comes our portfolio. This tells us what is a targeted portfolio by this mutual fund. So it is targeting to invest 0 to 100% over here behind equity investment, and this is what actually it is doing. It is actually investing only 86% in the stocks, 11% it is holding as a cash, and rest are invested in some government deposits, commercial paper, so on and so forth. This is an important point to understand. Thereafter, it tells us the sectoral distribution that this mutual fund has done. So it has invested in private banks, IT sector, investment and banking, specialized finance, FMCG, and there are many other sectors. It will also tell us the weightage by different institutions which are holding their investment in these mutual funds. Further, it will tell us all the stocks in which this mutual fund has its investment by its different weightage. So this fund is investing into HDFC, ITC, Bajaj Holding, so on and so forth. This was the details of the mutual fund. Now let us understand and decide what would drive this mutual fund, and this is where the logical part of this video comes. For that, let us see and decide all the parameters we just saw with respect to CAGR return that it has given, expense ratio it has given, Sharpe ratio, peer, sectoral distribution and current holding. Now let us draw some logical point over here as to why this mutual fund will grow if it has to grow. Let's first ask ourselves, will the past CAGR return of 13-18% this mutual fund has given, will that be a driving factor for this mutual fund to grow? The answer is no. Will expense ratio or the category expense ratio will decide the growth of this mutual fund? No. Will Sharpe ratio or the category Sharpe ratio will decide? No. Will its peers, how are its peers performing, will decide the performance of this mutual fund in the coming time? The answer is no. Will the sectors in which this fund is investing its money decide the growth of this mutual fund? The answer is very much yes. Will the current holding, the stocks in which it is investing, will decide the growth of this mutual fund? The answer is yes. So these are the two factors, sectoral distribution and current stocks, which will drive the future performance of the mutual fund, and not this previous old factors of CAGR return, expense ratio, Sharpe ratio and peers. No, they will not drive. So what we have to look after is these 2 points. As we know these driving factors, the first mutual fund that comes in our list is Quant Small Cap Fund. Now let us understand a 50% rule with this same example of Quant Small Cap Fund. So as you can see over here, there are several different stocks in which this fund is already invested, such as Reliance, HDFC and many other. To understand this 50% rule, let's take an example. Let's take one stock out of it which it is investing. Let's take this example of Zeal over here. So inside this particular company, this mutual fund has an investment of 1%, which also means that if you are investing 1000 rupees in this mutual fund, out of that 1%, which is equal to 10 rupees, will be invested in this stock. Now, if Zeal gives a return of 300%, let's say in next 2 or 3 years of time frame, that means the profit that you would have behind this one stock from this mutual fund will be somewhere around 30 rupees. So for you to get 30 rupees from this one stock, Zeal as a company need to perform, the stock need to perform by 300%. Let us go ahead and make this comparison of higher weightage holding by the same mutual fund. So if you see over here in Reliance Industries, the fund is investing somewhere around 8%. So taking the earlier use case of 1000 rupees you invested, out of that 80 rupees is invested in Reliance Industries alone. So in next same time period of next 3 to 4 years, if Reliance Industries gives a return of let's say 40%, which is equal to 32 rupees. So for Zeal to give you that same 30 rupees profit, Zeal as a company need to outperform the stock market and has to appreciate by 300%. Whereas the same result you will achieve if Reliance as a one single stock can perform by merely 40%. That's why considering the top weightage stocks, that means the top 50% of the holding of any mutual fund becomes very important. Thus, if you see here, Quant Small Cap is currently having 50%. Majority of the portion is invested in private banks, oil and gas, pharma, and then construction and engineering. Certainly, there are other sectors too in which it is investing, but that is a very small portion of its investment allocation. So if private banks as a companies in which it is investing, private banks perform well, very likely that you will get a good return by investing in Quant Small Cap. Likewise, oil and gas, pharma will perform well, you will get a very good return. That's why applying this 50% rule and considering only those mutual funds which is having an exposure into those sectors which are tend to grow and likely to grow strongly in the next over a period of years, you should consider investing in those mutual funds only. With that, let us understand this industry insights and why we should consider investing till 2028 at least. So we saw an example of Quant Small Cap Fund and we understood that it is majorly investing in private bank, oil and gas and pharma sector. Let us see whether these sectors are expected to grow or not only when the companies will grow. So as an example, as you can see over here, which is an example of a private bank. So private bank as a sector which is expected to grow at a return of 8% per annum by the year of 2028. This is an estimation done till 2028. We do not know what will happen thereafter, but at least for next 5 years, private bank is certainly expected to grow. Let us see another example. This is an example of oil and gas. As you can see over here, for oil and gas, the industry is expected to grow at a 5% compounded annual growth rate at least till 2028. That's a growth expected for oil and gas. Let us see the third sector in which it is investing, which is pharma. Now, if you see for pharma, there is a very good information. Pharma sector is expected to grow very rapidly. As of 2024, by the time we are watching this video, the industry exposure is now at a valuation of $65 billion, which is expected to grow to 130 billion. So in next 5 to 7 years of period from now, so by the time it grows to 130 billion, we need to understand what is the CAGR growth for pharma industry as an expectation. So if you see for that CAGR, let's put this number over here. I have taken 65 over here as an initial starting value and 130 over here. So it gives me a compounded annual growth rate of somewhere around close to 12.25%. So these three major sectors of quant small cap, such as private bank, which is expected to grow somewhere around 12%, oil and gas somewhere around 5%, pharma, which is expected to again grow by 12%, are the major sectors in which quant is investing. That is the reason if these sectors grow, quant will also certainly grow at least in the period of 2028, we know as per the estimation by various several research analysts. With the same logic, the second mutual fund that you can consider is Nippon India Small Cap Fund. So if you do its sectoral distribution and analysis over it, you will get to know that 50% of its allocation is in those primary sector which are expected to grow. Now the big question comes, how many mutual funds you should invest? Before that, if you want to receive more such investing ideas and you're liking this content and want to educate yourself practically and logically the way we did it in the investing world, then consider subscribing this channel so that you don't miss out any future opportunities which are available for investing. Now, the ideal answer of investing in the mutual fund is 2. You should always invest in not more than 2 mutual funds. Now, why 2 over here? Let's try to understand this through this comparison of 2 different mutual funds. So these are those 2 mutual funds that we considered. So let us compare them and understand how much stocks our investment will undergo. So for quant small cap, it is already investing in 91 stocks, and in Nippon India, it is investing in 196 stocks. So this is approximately 280 stocks in which our investment will undergo if we happen to invest in these 2 mutual funds. Moreover, certainly there is some percentage overlap. So roughly around 20 stocks will be overlapped. So even if we removed 20 from this 280, close to, we will have a diversification of approximately 260 stocks, which is very high in terms of diversification. In such cases, you can consider investing in either of these mutual funds, not to over diversify your investment, or on a safer end, you can consider investing in these 2 mutual funds. But only 2 mutual fund is what is recommended as a way of investing in it. So these are those 4 simple steps that you can consider in a sequential manner as to how you should be selecting a mutual fund in a best possible way. If you have liked this video and want to receive more of such investing ideas and business insights, then consider subscribing this channel. If you want to learn how Indian economy works, then you can watch this video. And if you want to understand how you can be rich being an employee, then watch this video. Till then, signing off. This is Ajinkya. See you in the next video.